All right, guys, welcome back to the channel. I have a very interesting video today. I want to discuss a couple different things. Um, I'm going to discuss two symphonies in Composer, one that I've created, and then one that was created by the CEO of Composer, Ben Roller. And then after that, I want to showcase some dividends that came off in the last 3 days, simply to show the power of compounding, and that when you build up an investment account and just basically do nothing, essentially allow dividends to come off and be reinvested, you're building wealth. And then the final thing is just a quick portfolio check, portfolio amount update, um, which I'll do. And I'll actually do at the end of today's close is when I run the whole month exactly, but I'll just give a general sense of kind of where the three main accounts are. So let's start off with the two symphonies. So this is a book here, and it's obviously reversed here every time I hold up books, but it's called Money Map by John P. Nicholas. And what's interesting, I read a lot of different books, not just on investing, in all different fields. And sometimes I'll read an entire book. This one is 225 pages or so. And there's one sentence or one paragraph or one chapter or one idea that I take away from it, that's profound and that influences me. And again, it doesn't have to be an investing book. It can be any book. But in this particular instance, John P. Nicholas, in the middle of the book, talked about factor investing. And he showed some data that was fascinating to me. And it led me to create this new symphony here, Factor Alpha. So let me just read how this is BlackRock, how BlackRock defines factor investing. And they define it as: factor investing is an investment approach that involves targeting specific drivers of returns across asset classes. There are two main types of factors: macroeconomic and style. Investing in factors can help improve portfolio outcomes, reduce volatility, and enhance diversification. So that's how they define it. In John's book here, he kind of breaks down, in this particular chart here, six different factors, and he breaks them down as market beta, size, value, momentum, profitability, and what's defined as quality. And one would assume there's certain indices that track these factors. But what's fascinating is the 20-year odds of outperformance on some of these factors. I just want to read them to you. I'm going to read it twice so it really sinks in. The market beta factor, the 20-year odds of outperformance is 96% chance of outperformance. Size is 86, value is 94. Momentum is 100% chance of outperformance over a 20-year period. And momentum, if we go back, a 10-year chance of outperformance is 97. A 5-year chance of outperformance is 91. And a 3-year chance of outperformance is 86. Profitability, the 20-year odds of outperformance, 93. And then quality, 96%. So again, market beta is 96, size 86, value, those who follow know that I have a value orientation, 94%, momentum 100%, profitability 93, and quality 96. So for those of you who follow me and just the way I've devised my investing, as you guys know, I call it syncretic, which is a fusion of disparate styles. And a lot of times I reference the Ray Dalio video, which you can find on YouTube, The Holy Grail of Investing. And that's kind of what I'm doing with Composer and my investments overall, is really trying to find things that backtest alpha. So they provide me with alpha. And if I can build systems of trading, essentially, that backtest as alpha over a long period of 15 or 20-year period, and then I put capital into each of those buckets. Now, again, the past is not prologue. It's not guaranteed that the next 15 or 20 years are likely to be that. But my idea is that I'm pursuing alpha. So for me, I'm not pursuing like necessarily high Sortino, Sharpe, Kalmar ratios, high risk adjusted returns. I'm looking for things that, I mean, that's somewhat interesting to me. But what I'm really looking for is that alpha. I can get a percentage of alpha, 2% of alpha over SPY. Um, and then I can build something where there's 10, 15, 20 of these. I actually have 76 running, 77 now, I guess, running in Composer. But so that I found to be fascinating, seeing that. And then the other thing that was eye-opening for me was on page 165. He talks about the annualized returns from 1975 to 2020. So it's a long period of time. You're looking at like what, 45 years on that. So large cap US stocks, the return there is 12.5%. Large cap US growth, 13%. Large cap US value, 14.1. Small cap US stocks, 15.5. Small cap US growth, 15.3. And then finally, and this is the one that really stuck out to me, small cap US value, 17.3. So for those of you who follow investing, a lot of people are, buy VOO and go home. It's kind of the cult of Jack Bogle. And Warren Buffett has also promulgated that, and says that, if people ask me for advice, I tell them to buy the Vanguard S&P 500 index and go home. What's fascinating to see is that for someone who bought small cap, which Vanguard has VB, the ETF, and small cap value, VBR, instead of VOO, you attained about 3 percentage points of alpha on the small cap and 5% in the small cap value. And that's amazing to me. Basically compounding capital at 17% over the long term. It's just amazing. You can pull up a compound interest calculator. That'd be a cool exercise, and put in, $100,000 over 25 years at 12.5, and $100,000 at 25 years at 17.3. So seeing these two bits of information caused me to create this factor alpha symphony. And what I wanted to do is I wanted to put, so let's look at it here. I put, okay, so factor alpha. So momentum, MTUM, this even says factor ETF. Okay, so in the 20-year chance of outperformance, momentum had 100% chance. And then this is another factor, quality. I just mentioned that the small cap value and small cap, the small cap value was 17% and the small cap was 15%. So VBR and VB from Vanguard. And this is another one here, minimum volatility, and then the market beta. So it's just a laundry list of ETFs. I believe I rebalance it once a year. If you wanted to rebalance a little less than that for tax purposes, every year, yeah, there it is, every year. They actually introduced a threshold trading. So you could set the threshold pretty high where it wouldn't rebalance that often. Maybe it's every couple years. You could set it for like 7% or 10%, meaning the percentages would have to really deviate in order to do a rebalance. But I just set it for every year. That's fine. And so now the Goldman Sachs one here was just introduced. So it limits the back test of 2020. But before I added the Goldman one, I actually had it where it was, I believe, like 14% going back 5 years or so. But let's just come up here. So 25.6. This is June of 2020 to March 30th of 2022. They also added the fees and slippage in addition to the threshold rebalancing. These are some updates. And see, it calculates the fees and the slippage. The slippage is the estimated difference between hypothetical trades and actual trades that pay bid-ask spreads and experience price movement. So, between the sort of generic back testing and the actual if you were trying to fill these orders. But compared to the SPY, it's quite similar right now, 25 and 27. But it'll be fascinating to track these, this kind of laundry list of factor ETFs rebalance once a year over the long term, and how they do. So yeah, and again, the cool thing about Composer is you could be reading a book on investing and see something you want to create a symphony on it. You could be, having a conversation with a friend, a Reddit thread, an essay, and quickly go in and create it. So I actually put $2,000 to this yesterday. So he's followed since March 2028, and then I put $2,000 in yesterday. And then the other one, I actually got an email from the CEO of Composer this morning, and he kind of showcased his rising rate risk parity. Why do I want to show this? Because a lot of times I've created laundry list symphonies, which are pretty basic. So that one is just like, okay, pick out 4, 5, 6 factor ETFs, rebalance once a year. But this one really showcases the complexity that you can build symphonies with. So he said that, notice the threshold. It's not daily or monthly, yearly. It's a threshold one, and I'll read it to you. Risk parity. Whenever I hear the word risk parity, I immediately think of Ray Dalio and Bridgewater. Obviously, you could also mention Cliff Asness and AQR, but let's read it here. Risk parity, but make it Fed friendly. This symphony seeks to navigate a rising interest rate environment by including financials and avoiding equity and bond market volatility. The symphony is risk on if treasuries and SPY are stable. Otherwise, it adds risk off assets, including gold and the US dollar. The risk on assets are an inverse volatility weighted blend of 3-time levered ETFs representing large cap equities, financial, and long dated treasuries. This symphony was developed by Composer. By choosing to trade this strategy, you understand that the strategy employs ETFs and that you understand the associated risks of trading, holding, and costs associated with ETFs, and also leverage ETFs. Before investing in any strategy containing an ETF, please review the relevant ETF prospectus. So there we go. And so this is, I back tested it going back 2016 to now. So a good 6 years. And you can see the annualized return, max drawdown, $10,000 over the 6 years turned into 35. You can see the slippage. That's the difference between the bid and the ask and the fees they associate there, which is a wonderful feature. And again, it definitely attained alpha over SPY over the last 6 years. Now, that doesn't mean the next 6 years will be the same, but that's just interesting to see that, you're at 23.8 versus 16.3. And just look at the how this is really constructed here. So I guess every day, ask whether the SPY 10-day maximum drawdown is above 5%. If yes, use safe haven. So if there's been a big drawdown in SPY, you're in the safe haven. If no, then there's actually another conditional. If no, ask whether the TMF 10-day maximum drawdown is above 7%. If yes, safe haven. If no, core risk parity. For safe haven, weigh these assets by the inverse of their 45-day volatility, and then you have the assets GLD, UUP, UPRO, TMF, financials, FAS. Let's see here. For core risk parity, weigh these assets by the inverse of their 45-day volatility. So there's like a double conditional there, which is interesting, if I'm reading it right. It reminds me, there's actually one, I think it's called GTAA 13 that they have, and it was modeled on MEB favor, and it's also very complex in its logic. But it's a cool contrast to see the factor alpha, which is just kind of a laundry list, and then this on different conditionals there. So yeah, and so you can see here like what it would be holding now. Its percentages here. See, so a lot of it would be in the US dollar index bullish fund. And some gold. So yeah, so this is something that I would also be interested in, putting a couple $1,000s. I just like to put a couple $1,000s in different symphonies and then track them over the long term and see which one does better in different instances, which one does better over the long term, so on and so forth. So let's transition into dividends. And, I have a saying, even say every day I'm getting richer and richer. And these are days even when the market is selling off. And because I own different ETFs and stocks that pay dividends, because I've chosen to reinvest my dividends, I'm accelerating the principle of compounding by reinvesting my dividends. So I just kind of want to show this. This is just the last 3 days of March. Okay. So this is just 3 days of dividends here. So you see some of these are leverage ETFs, pill, cure, DRN's a leverage real estate fund, TMF, yin. So you got, that's an energy arms, a PFFA, preferred shares. A lot of the V's are going to be Vanguard. So VDC is a Vanguard, VPU, nice 1045, EOG Energy, VFH Vanguard, VHT, Shell 978, VGT up here, Vanguard, QYLD. QYLD is an interesting, it's kind of a YouTube ETF, if you want to call it that. A lot of videos on QYLD. The one guy I've seen a lot of videos is the Average Joe Investor. So if you're interested in QYLD, you can go watch some of his videos. And he does some nice spreadsheet breakdowns if you invested in it in the past and what it's like for the future. But $11, There we go. VOO, the holy grail of bogleheads and Buffettologists and so on and so forth. Nice railroad, leverage ETFs. Again, this is just 3 days. SFL, with SFL, I feel like Aristotle Onassis, shipping company, big $64 dividend. And again, all of these are purchasing more shares. So I'm not taking this capital and saying, oh, let me spend this. This is going in back into the compounding machine, essentially. Let's see, IDV, Noble, that's a Pro Shares Dividend Aristocrat, 774 right there. Goldman Sachs, 1435. I actually just picked up Goldman Sachs recently. It seems very undervalued. You can pull it up on Fast Graphs. Even Jim Cramer talked about how undervalued it looks, and others. So a lot of the financials look undervalued now, like things like Manulife and Goldman and Allstate. Some of the insurance and financial services companies. But yeah, $14 there from Goldman. Gilead, $35. Going through here, UHT, that's a REIT, 844. Clipper, another REIT, 807. BGR, Land, 214. So again, look at this. I'm just going to go one more time just to quickly look at all these dividends in the last 3 days. And there might be some more that trickle in before the end of the day here. So that just gives you a sense that once you create a portfolio, depending on how you construct it, it's just going to throw off dividends. So, I'll know in a few hours it's 11:11 here in South Florida, but at 4:30 or so, when I start to compile the month, I might be at $1,000 to $2,000 this month in just dividends. It'll be fascinating to see that in 10 years. But let's go, and I'm going to finish up here with just a quick portfolio update. And obviously, I will do this at the end of the day today. But I just wanted to give you a quick sense. You can see here the big sell-off, and then it's kind of rebounded a little bit here. So this account is kind of flirting with that 600,000. It was at 670 as its high. So let's go there. And then now we're going to go to Alpaca. And Alpaca is where I have all of the composer symphonies synced into. So 133, 21558. And then the last one is Interactive Brokers. And that one is 343,889.98. So 1,063,811, and then I have a couple small accounts, 30 to 40. I'll know at the end of the day. So I'm kind of right at that 1.1-ish number. It's holding about 1.1 million in the Maneos Compounding Machine. Just kind of riding out some of the sell-offs, but with option premium, with dividend reinvestment. That's why I use the term every day I'm getting richer and richer. So with that being said, hope you enjoyed the video on the two symphonies, the dividends, the portfolio update. Any questions on Composer Symphonies or anything else, feel free to comment, message me. And yeah, take care. Ciao.